So every trader in the entire industry has a strategy. Whether you're an SMC trader, an ICT trader, I've found many traders that say they have the same strategy that trade completely the opposite. And it is a little bit confusing because if you're an SMC trader and then one SMC trader is buying EU and at the same time another sworn SMC trader is selling EU, how can that make sense? And in a previous video, I've explained my exact checklist from what I think is a great strategy to what I think is a trash strategy. And myself, after trading for almost a decade, making millions of dollars from the markets, and now even calling the market live ahead of time for over 7 months to publicly document 60% gain, what I've learned is that more important than strategies is your confluences, and more important than that is how you ladder your confirmation types. So let's say you're a trader that believes in Fibonacci support and resistance trend line and a moving average. Great, you have things you like now. Now you're going to mix them in a way and probably a little bit different every day, and you're going to call that a strategy. That's what every new trader does, and that's why 90% of traders lose, is because they just take information from the industry, throw it and see what sticks. That's not what profitable traders do. A profitable trader's job is to take information, synthesize it into a strategy. And the way to go from information and courses to a specific profitable strategy is having a confirmation checklist and then creating trade models that are mechanical and repeatable and knowing the KPIs and the data for each one of your models. So what we're going to do today is go through all of the most common confluences and confirmations that people use, the way that people look at the market, not strategies, but specific concepts, specific reasons that they enter the market, and put them in a category, whether it's a baller category, the profitable category, the almost there category, or all the way down in the trash category. And this is going to help you decipher which confirmation types, which confluences you should be using. From the ones that you are using, which ones are more important than others, because you're going to understand this key concept of hierarchy of confirmations. If you don't have a hierarchy of confirmations, you are still a lost trader. So the first one for all my ICT lovers, my SMC lovers, the holy order block. Now order blocks are fairly misunderstood in my opinion, because people just take the last up candle or the last down candle and say that is an order block. And okay, that is like level 1 entry, but you can take order blocks to a higher and higher level. For example, if you can combine them with timing, if you can combine them with a run of liquidity, you can add so many more things to the order blocks. Now order blocks in theory, they do need mitigation, and we can see it time and time again. I can just pull out any chart on any currency pair and I can show you dozens and dozens of examples where order blocks are getting respected. So I do think that they are quite important. However, we have to know exactly how to utilize them, because if you're one of those traders, and I've seen it from new SMC traders, when they discover what an order block is and they test it for a few hours and they see it's really powerful, it will seem like a miracle. It will seem like the most powerful thing. And then what do traders do? You will end up just bouncing from order block to order block, and you'll start trading pretty much every single order block you see. And that will lead to vast unprofitability. So the reality is order blocks are powerful. Order blocks are important, but you need to know which ones to use and which ones to ignore, because not all order blocks are created the same. So if you can correctly identify them and then add things to support them to make them as reliable as possible, then I think it can be in the baller category. But if you're just using the definition of the last up candle before a move down and you're just trying to trade every single order block, I'll put it in the trash category. So for now, I'm going to put this in the profitable category, and later on in the video, the other things I'm going to explain will help you understand how you go from profitable order block trading to baller. The next one is going to be a break of structure. So a break of structure is something that everybody learns in their first day of trading, when you're learning baby pips and the most introductory concepts, higher highs and higher lows and lower highs and lower lows, and therefore the break of structure associated with that price action. So when you look at the market, once again, just like the order block, you will see breaks of structure everywhere. And if you look at the higher time frame, you'll see break of structures often lead to price coming back and making a lower high after making a lower low. So we can see that it is fairly reliable, especially on the higher time frame. It basically works like clockwork. But it's also important to know that every trend must come to an end. So a bearish market, all of the breaks of structure you are trading, the lower highs and lower lows, eventually you'll reach the last lower low in the market, and then a bullish market will continue. When you're looking at the break of structure from one time frame, it seems very easy, but the reality is the market is stacked from different time frames, where for example you can have a bullish daily time frame and then a bearish M15 and then a bullish M1, because multiple time frame analysis is important. So if you correctly identify a break of structure, once again, it is going to be in the baller category, because this is your first sign of intent. But the problem becomes is you have a lot of fake breaks of structure, and a lot of breaks of structure will be exactly the same in signature to an inducement. An inducement being a run of liquidity where the price goes in the opposite direction. So you can go from the baller category to the trash category once again very quickly. For now, I'm going to put it in the profitable category, and once we add things on later on, we will see how we avoid putting it in the trash category by misunderstanding market structure, the relevance of moves, and actually put it in the baller category, where we know exactly what are the the meaningful breaks of structure. Now, the next one is a Fibonacci. Now, Fibonacci, once again, is one of those things we learn in our first week of trading. It looks very powerful. It looks technical. It comes as a built-in tool within TradingView. So my natural inclination was to think, if it's on the platform, baby pips, and everyone's talking about it, it must be real. So when I started to look deeper, I understood that I want to trade the market not from a perspective of correlation. I want to look at the causation of the market. What causes the market to move, not trading things that just happen to align with it. So a Fibonacci level can be great. I personally don't use it. I don't think it's the most important thing, but it can be great. And I'm going to put it in the profitable category because I've seen people utilize it profitably and I like what it represents. But Fibonacci as a guide is like when you're learning to ride a bike and you have your training wheels on. It's great. You can still ride the bike. You can still go fast. You can still complete your journey on the bike. But I think there's better ways to do it. So have you really understood the market? Have you really got precision? I would say no. But can you get profitable trades from it? Yes. Can you get good entries sometime? Yes. Can you get a positive risk reward? Yes. So these things are all great, but I just think they are almost there. And what a lot of people do is they combine it with a break of structure, they combine it with a supply zone, and they combine it with a trend line, and then add a Fibonacci on top. These will lead to profitable trading. I wouldn't utilize it right now because the KPIs that are important, win rate, risk reward, rate of return, that strategy alone won't optimize for that. The next one is a trend line. People swear by it. And to be honest, it's the power of backtesting. I can show dozens and dozens of trend lines that work, but the problem is trend lines are very subjective. Everybody can draw a trend line slightly different because it's not an exact science. It's just trying to vaguely connect 2 or 3 points, and sometimes the points won't exactly touch. It will be plus or minus 10 pips. And what we also see is every trend line fails. So after 2 touches, the trend line might fail. After 3 touches, it might fail. And the reality is, when you have a trend in the market, lower highs and lower lows, most of our retracements are going to be 50 to 60 to 70%. That's where majority of retracements lie. So if you see that you have a trend and we average each retracement at 60% and we're connecting these dots, what we've really done is draw a line to represent market structure. I don't think trend lines cause the market to move, but they are just nice dynamic levels that we can look out for, that we can utilize as a zone. So for now, I'm going to put this in the almost category. It's not trash because people make it work. And the reason they make it work is because they add other things to heavily supplement it. Utilize it if you want. It's beneficial, but there's a lot more things we can do from the base of a trend line. Next is support and resistance. Again, baby pips 101, trading 101. Now, I want you to do a little experiment. Open up another tab, go on TradingView, go on the 5 minute, the 1 hour time frame, I don't care, and get the horizontal tool and just drop it anywhere. And then zoom out and look across, and you will see, guaranteed on any currency pair, on any time frame, that random line you draw will have perfect support and resistance interactions. And that's a perfect example to show how support and resistance is a correlation, not a causation. Again, it has virtue in it because there are big institutions, there are big players that are utilizing support levels, key levels, these kind of things. But is it the most important thing? No. Is it going to be very reliable? No, because a random line can actually verify it. So unless you have a strict criteria to really strengthen a support level where you're using a lot of other things, I'm actually going to put it in the trash category because a support and resistance level does work, but the concept alone is not important, and actually it misleads a lot of people. A lot of people lose a lot of trades and blame it on a stop loss hunt because their levels get targeted. A run of liquidity is going to happen in obvious zones where a lot of people are entering, and the most obvious place people enter is a double bottom, a double top, and we can see the breakout trade is getting manipulated. The support and resistance trade is getting manipulated all the time. So I think be very careful with it. It's going to add not much to your strategy. It's going to mislead you a lot, and it gets heavily manipulated. That I would say disregard it unless you are a higher time frame swing trader that is predominantly using fundamentals, and therefore you're just executing on a support level with a large stop loss based on a long-term bias, so that intraday movements, runs of liquidity is not going to cause you to get out. By the way, if you're enjoying this video, do let me know exactly which of the confluences you want me to cover more in detail to show you why I ranked them in the way that I did. For example, if you want me to go at length explaining through chart examples why trend lines don't work, or through examples explaining why certain order block types consistently fail, do let me know and I'll make a completely separate video showing evidence of all of the claims I'm making today based on my rankings. The next category is a candlestick pattern. It's basically the ABCs of learning how to trade. You first learn candlestick patterns before you build a strategy. A lot of traders actually put them into the trash category, or they disregard them very easily, and the reason they do is because they think they are better than that. They upgrade their strategy, they move on beyond it, and therefore they discredit anything that they learned in the introductory days. Now, what traders have to also be careful of is, in pursuit of excellence, in pursuit of competition, complications, because traders usually overcomplicate things, they look at anything that's simplistic and anything that is foundationary as it must not work. And to an extent, that is true with a lot of things. However, with candlestick patterns, I guess a lot of you probably guess I'm going to put it in the trash category, but I'm not going to. I'm going to put it in the profitable category, but it really depends once again on how you deploy it. For example, if you're just using a daily time frame supply zone and then you add a simple doji candle, well, that's going to fail more often than not, because in the space of a trend, you will see the odd doji candle. That is not reflective of a change. That is not reflective of a rejection, and therefore can be rather misleading. However, if you build it as one component in a multi-layered strategy where the candlestick pattern is there to identify a true rejection and you're managing your risk in the correct way alongside this rejection point, then it can be quite powerful. Let's say you have a supply zone and you've refined that supply zone down to an M5 to find the preferred inducement point within a higher time frame POI. Now you take a daily POI and you can reduce it down to a M15 or M5 zone. So when you have this hyper refined zone, then you allow yourself to come into the current day's price action and you watch how the price action presents. Now a level 1 trader can simply take a doji candle, a reversal pattern, for example, a morning star and evening star, these different kind of rejection candlestick patterns alongside this refined area, and they put their stop loss at the high of the zone and they take that candle based on a London open or a New York open. So you've added time, you've added a form of rejection, and you've added a safety net in terms of a stop loss on a valid area based on the supply zone. That is a level 1 way of trading, but I would argue it could be quite profitable because you are adding good approaches to it. Now, do I think you can take it a lot further to make it a very profitable or even in the baller category? I certainly do think so. But what are we trying to emulate here? We're using candlestick patterns to mirror other things, to supplement for a lack of knowledge in other areas. So for now, as an introductory trader, if you've been trading less than 3 months, I would say candlestick patterns with refined market structure and refined time windows to supplement for the daily cycle. This can be a profitable approach, but I wouldn't stay here long term. And the reason I'm still going to say it's worthwhile pursuing is because all of the things that I just mentioned that I like, displacement, fair value gap, inducement, these same characteristics that I see in price action, if I put it onto an M15, it will usually look like a doji candle, or it will usually look like an evening star reversal pattern. The market is not reversing because of the doji candle, rather it's the other reasons I mentioned. However, the doji candle will be a nice representation of the true drivers of the market. So in that sense, it's a good foundationary point before you really learn how to delve into the M1 timeframe. Next category is going to be considered a sweep. Now, a sweep is basically an ICT or SMC term that is pertaining to a run of liquidity. And usually they layer it into 2 categories of buy-side liquidity and sell-side liquidity. However, at its core, it is very similar to an inducement. And in fact, when you have an inducement on one hand and a smart money sweep on the other hand, you will have areas where they do overlap. And the reality is sometimes it is very hard to differentiate between the two of them. And therefore, my valid losses that I take in my strategy utilizing inducements are usually because I labeled it inducement, but in reality, it was a sweep. But a refined trader will have clear differentiators between a sweep and between a real inducement. Now, real inducements, we can categorize them through major, medium, and minor, and then you can layer them into multiple levels based on what you are inducing, and also based on the time of day and based on the type of displacement. For example, a requirement of a break of structure with the invalidation of it doesn't come to a demand area. So there's many layers you can take an inducement, and it is fairly advanced. However, SMC traders, they'll be looking at it as more of a pattern. They will see a range of consolidation and they'll look for the first spike out, or they'll see a buildup of Asia range and a London spike out, a stop loss hunt. Now, the reality is a stop loss hunt is very similar to a break of structure. So you might be seeing price coming higher to do a sweep, but at the same time, that is exactly the same as a bullish break of structure. So then you need to have clear differentiators there. And in fact, a buy-side liquidity or sell-side liquidity sweep was something that was extremely reliable just 5 years ago, and something that I was utilizing extensively in my strategy just 5 years ago. However, now in this current climate, smart money traps is a real thing. In fact, I made one of my most viewed videos at 200,000 views as a full guide breaking down smart money concepts and how smart money traders are now falling victim to a new concept called smart money traps. I come with evidence. In that case study, I showed over 30 examples from my exact public signals of how I was utilizing smart money traps within my strategy to be profitable, with the documentation of 60+% gain that I've shown in my live signals. levels. So 5 years ago, I would have put a sweep into the baller category, hands down. But now I'm going to put it in the almost there category, because to go from a sweep and a run of liquidity to an inducement, it just requires a little bit more understanding and a few more requirements to differentiate between the two. And if you are a trader that wants to level up your game and know how you can use your core understanding of sweeps and take it to another level to be truly profitable, because I'm sure you're in a situation now where you're trading sweeps and sometimes it works, sometimes it doesn't. And a lot of the times you take stop losses and you don't truly understand why, because you saw a sweep and then you saw another inducement. One nugget I can give you for today is utilize the same concept, but better differentiate them through time of day, through the displacement type, and wait for a medium inducement. A medium inducement is at least a run of liquidity of a M15 structure point or of an Asia range with a significant reaction, and know your invalidations. Therefore, you're not just looking at every single build up and sweep. You are looking at the relevant ones based on time and relevant ones based on what they are inducing. You don't want to be trading every single sweep, because you will end up like those lost order block traders that you're looking at every single run of liquidity and mislabeling breaks of structure, mislabeling inducements, and mislabeling smart money traps. And that sporadic approach is probably where you are lost right now if you're in that situation. Next, we have pattern traders. Now, pattern traders, just like candlestick pattern traders, are a very introductory point. And for a newcomer in the industry, a new trader, you need to simplify things so that they can have a foundational point to understand the complexities and the realities of advanced price action. So a lot of traders boil it down and condense it down to simplistic diagrams of patterns, a head or shoulder pattern, a teacup pattern. Well, the reality is, let me just ask you a simple question. Do you think hedge funds and institutions are investing billions of dollars into a trade because of a pattern? Do you think a liquid market that moves over $5 trillion in a single day is because of patterns? If that's the lens you are holding on the market, you have a long way to go. Now, that's from a perspective of wisdom and reality of how the market operates. However, utilizing patterns is still fruitful. I'm going to put it in the trash category, because I think there's so many more advanced ways that are more realistic, have better wisdom, have better precision and accuracy. However, I can't completely disregard it and say avoid, because what the patterns represent is the reality of the market. Just like I mentioned how M1 inducement, M1 break of structure, displacement, and all of these characteristics that are true primary drivers of the market can be nicely reflected from an M15 doji candle. And that's just the reality. It's not causation, it's a correlation. The same goes for pattern traders. It won't be the best type of trading from precision, accuracy, risk to reward, win rates, but it can be still enough to have a baseline level of profitability. So therefore, I'm not going to disregard it altogether. Next, we have Wyckoff theory. Accumulation, reaccumulation, distribution, redistribution. The market cycle. Now, this is an entire school of thought by Richard Wyckoff that was developed many years ago and is very well documented in multiple market types. So it is one of the laws of the market on how the market will move. It's impossible for the market to move in any other way. Once you have an expansion, the buyers are going to exit and the sellers are going to enter. When that exchange is happening, you will have a zone of consolidation where these orders are interacting, and that can be signatures of accumulations and distributions. And the evidence is very well documented, the literature is there, the case studies are there, and the proof is in price action. And I'm going to put it in the very solid category. I think it's a great way to look at the market. However, you need to understand that when Richard Wyckoff developed the concepts, he was still utilizing rather rudimentary ways on entering upon the theory. The theory itself is significant and valid. You don't need me to prove that to you. That is very well documented. However, if you are taking an accumulation and you're entering and the breakout of the zone with the stop loss at the low, that can be a 50 pip range, a 50 pip stop loss. And I think there is better ways to refine that. In fact, I've done many trades where I've entered an accumulation with a 5 pip stop loss. So I've been able to catch a full expansion on a swing trade perspective with a scalp style entry in terms of my stop loss. And that's simply combining Wyckoff theory with M1 mastery, with inducement cycle and daily cycle and other types of ways of trading. And that's where I'll really put it at the baller category, because you can get large moves, violent moves, aggressive, intenseful moves with sniper precision entries with lower time frame confirmations. And when I was a swing trader for around 3 years, that's exactly what I was doing. And that's exactly how I was able to achieve really large risk to reward trades. But I think if you want to be utilizing Wyckoff theory, it's a great place to begin. But the way you deploy the understanding, if you're utilizing trend lines and Fibonacci's and support and resistance, I think it will still be profitable, but you can improve it through better understanding of price action. Now we have supply and demand trading, and this is one of the essence of the market. It's something that basically every trader knows and understands, but they don't take it all the way to the full extent that it can be. As a base, supply and demand trading is great. Without demand, you don't have movement. Without supply, you don't have movement. It's one of the primary drivers of the market, and it is heavily linked to market structure. Demand areas will lie around where you have breaks of structures originating. So you have the law of cause and effect. You have a higher low leading to a higher high, new territories found, new impulse, new break of structure, and where that originated from is a demand area where you had the intent coming in to allow that break of structure to happen. And within there, if you can identify true displacement through imbalances, through momentum, through internal breaks of structure, with inducements to the low, these things will really confirm demand areas. But again, there is many types of supply and demand area. You can have weak supply, you can have strong supply, you can have daily time frame supply, M5 supply, you can have counter trend supply points. There's so many layers when you introduce market structure to its full extent. So there's many layers to it. I think once you fully understand market structure and you fully understand supply and demand, then I think this can be a baller strategy. You can actually use a daily all the way down to an M5 approach, multi-time frame analysis, utilizing only supply and demand and market structure, and you can be really, really profitable. And I think it's a great place for people to begin after your first 3 months of learning baby pips, support and resistance, candlesticks and trend lines. Quickly advance onto market structure, supply and demand and wick-off theory, and spend at least 1 or 2 years there. That will be enough to make you a profitable trader, I'm confident. And if you really want to take it a level further, then you add in the things I often speak about on this channel. But supply and demand is the essence of the market. It's the law of the market because of the law of cause and effect. And I think it's a very accurate, reliable way to begin your journey into profitability. Lastly, we have inducements, a very misunderstood term, a term that everybody is throwing in the industry and a concept that everybody is trying to utilize. But the problem is it's something very specific. And unless you monitor significantly a large sample size of price action to truly see how inducements work, as I previously mentioned, knowing the difference between a major, medium and minor inducement, knowing the difference between time-based manipulations and how that can come in, knowing the difference of confirming it and invalidations of inducements, and differentiating it between a smart money sweep from ICT and SMC to SMC traps to a real inducement. The law of cause and effect never lies. The law of the daily cycle never lies. So if you can peg inducements to these things, you will always be in the best seat you can be. I put this in the baller category if you can truly understand it, because it's the signature of the essence of the market. It is the signature that will improve your wick-off theory, your daily cycle trading, your market structure and supply and demand trading. This concept alone makes any strategy better. Even if you are just a head and shoulder pattern trader and you add correct inducements, you will significantly improve your strategy because you are aligned with the market. The market goes from an intraday and intra-session perspective through liquidity. So price goes from A to B. That A to B can be market structure, that can be supply and demand, whatever takes price from A to B. But how that will happen will normally be because of an inducement on a lower time frame. So if you can say I'm a head and shoulder trader and you execute your right shoulder entry based on a medium inducement, it's a good strategy. If you are an accumulation based trader, a wick-off theory trader, and you wait for the spring, which is essentially an inducement, you've improved it now because you won't be falling for fake outs or for breaks of structure, something that would ordinarily be the weaknesses of wick-off theory. You could be a Fibonacci trader and have significant reliance on market structure and Fibonacci levels. But then if you execute that trade, which can be profitable based on law of probability, that's what Fibonacci is, but then you confirm your Fib level with an inducement, you've now improved that strategy. So inducements is something I speak about a lot on this channel. I've shown case study after case study, example after example, and every single one of the live call outs that led to 60% gain this year so far, every single trade was because of an inducement. So if you are still a non-believer, go ahead and study and test it. No matter what type of trader you are, whether you're a fundamental trader or an M1 trader or an SMC trader, inducements correctly identified will always improve that strategy. So don't neglect it. If you take anything away from me, anything away from this channel, let it be that, on top of something that is always going to be crucial for profitability on any trader, and that is a restricted trader is a profitable trader.